Hey, greetings and welcome. It's Tuesday, time for Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm very excited to be joined by Jonathan Gibbons of VigTech.io, where I also host my risk indicators. And we have partnered in crime on this particular series on Tuesdays to talk about market structure and then a thematic macro, subject that's near and dear to our hearts or is very timely, and right now it happens to be inflation. So last Tuesday, Jonathan actually stoked the fires of inflation even more by saying the word hyperinflation. We could be in it. And I thought to myself, nah. And then I thought to myself, maybe. So we're gonna dig into that, and let's do this housekeeping real quick, and then I will bring him in. First and foremost, if you are on my website, you'll see a guest captain interview series where I post my interviews, again, Tuesdays with Jonathan religiously. And then Thursday, I have a guest speaker. In particular, I also share a series called Women in Finance and Trading. That is going to be this Thursday, and I'm very excited. I have Katie Stockton, who is an institutional technical analyst of great credibility, and I'm excited to talk with her about her travels in this on the institutional realm as a technical analyst. And you can sign up on my website. This is also, when it's done, will be housed on my YouTube channel, which is going to be LaDuc Trading YouTube channel. Pretty simple. And then down below, you're going to see where there's macro to micro power hour. Last Thursday, I had Jem Karsten, who you probably know, who if you're on FinTwit anyway, market timing calls. He's a quant, and that was very insightful. Also got his views on inflation. But I will be posting this webinar to my YouTube channel. This will also be on Spotify and Apple as a podcast and Audible. So just look for or search by Samantha LaDuc or LaDuc Trading, or your favorite guest that I'm featuring here, and then you'll be able to get that podcast while you're out and about. So again, this is a theme that is my marketing director has a good sense of humor. It's 1970s style hyperinflation, maybe, and we're going to talk about that. We've gotten already a lot of pushback that maybe stagflation, not hyperinflation. But we're gonna dig into this. And Michael Burry, by the way, warns of it also from The Big Short fame. So, without further ado, Jonathan Gibbons, you are in the house. So let me do a little intro to promote you to panelist, and you should be there. Yay, he is.
I'm here. Can you hear me?
You're there. All right. So you're the one that kind of triggered this topic of hyperinflation. You said something kind of insightful last week. Well, you always say insightful stuff, but I mean, you were basically posing the potentiality that we might be in a bit of a hyperinflationary backdrop. And I want you to explain yourself. And then I dug up some research to kind of chart in particular that I had retweeted that did give some parallels to a 1970s hyperinflation type of start. So, what made you think of that?
Um, Predominantly the thought that was running through my mind last week, and then really had been running through my mind for a couple weeks, was you see massive changes in prices, right, for goods that off the naked eye are really abnormal. And so there's a couple justifications for that. Commodities have been in a downtrend for multi decades. Supply demand, just some very technical normal responses to that. But to me, it seems like something that's more sensible, that's getting discounted a lot, is that we didn't have the fallout that we expected to have from the policymakers as relates to COVID-19. It was a shorter duration pain trade that was over responsed, as King Griffin would say. through the fiscal and monetary stimulus functions. And we've had, I think it was 9 trillion, 8 to 9 trillion added in between Bush and Obama eras, something to that effect. And then we did upwards of 11 to 12 in 12 months. And a lot of that went directly into fiscal, into the hands of individuals. It went into the PPP that was and is going to go down as one of the greatest heists in the history of America, where people literally put it in their pocket and never close their businesses, especially businesses with size. So anybody in the $1 to $2 million range, right under the thresholds. A lot of
Not
those
to speak of
businesses
even a long list of hedge funds that took PPP or
for
some very
multiple,
famous celebrities, but we're not getting into
multiple
that.
people took
Yeah. Mhm.
multiple rounds, and so that's direct. That's not through a monetization mechanism through bond buying and the stimulation of mortgage-backed securities. That's direct fiscal money from Treasury to people to spend on goods, and that is not stagflation. That is something that has not been experienced before at this size, at this velocity, or in this time frame, this shrunken of a time frame. And you're beginning to see it manifest in very, very rapid, strange ways. And we've joked it through with crypto stuff or NFTs or a lot of this stuff, where it's like this is a trend or a fad, or it's like the 70s, or it's like the 90s 99 period. It's like the tech bubble. There's a lot of similarities and different pieces of this to those eras for sure, but this feels different in the sense that um, you've got help wanted signs on almost every business, and many of these businesses were given fiscal stimulus direct, and they can't hire because the people aren't going to come back to work because it's not in their incentive to come back to work
I
because they're making,
jokingly tweeted last week
yeah,
that it wouldn't surprise me if they give stimulus now to out just for people to take jobs. But they are also, even today or yesterday, the White House said if you're on unemployment and offered a job, your unemployment, we're going to talk about ending that. And I've seen
yeah,
that,
yeah,
anecdotally, Home Depot, the same thing, come back to work or else we're going to let unemployment know that you refused a job, that kind of thing. They're
yeah,
trying. They're trying.
yeah. But the problem is that and I can understand those quality response mechanisms and it makes sense. But the problem is that it's too big, right? And it's gotten so big that now you've got kind of an interesting conundrum because the Fed and the policymakers have inflation and they can't control inflation because the pension system and the raising of rates. I think that I saw yesterday if 4.25% real is something of a marker. You posted it, right?
I
Correct.
did.
Okay. And
Yes.
so
Yeah.
there is an incinerator moment where real estate and all the leveraged vehicles are become not a pain trade, but like have some systemic risk because of the way that the interest rates have been so long, so low for so long that the environment can't sustain or support those type of the rate raise. So you look at like a Volcker move in like the late 70s, early 80s, where he was like, I'll fix this, watch this. And, rates just went through the ceiling. They killed inflation. And then it begat the entire super cycle that we've been experiencing since
Yeah.
then.
40 years.
This is not that because you're talking about $11 trillion in the ecosystem that went in. This is not that. And what are you going to do with people that are, if you do have deflation and you still have high inflation, stagflation, there's some discussion around that conversation. How's that shake, where assets, which are holding the whole system together now, all this asset growth, right? Everybody's just, completely happy with the situation. I mean, you could see it in the market structure where, these things like, yeah, they move quick because everybody's kind of nervous to an extent. It's like, yeah, I don't want to be the one in the musical chairs if this thing starts to unfold. And you got Matt, you got selling. So I think that the scales have been so tipped with this situation, and the size of this thing is so great as to the size of the problem, that the policy response is just a little bit less clear. And I don't know that it's digestive. Um, you know, that it's going to be so simple to just digest. And it's interesting because Griffin had said something about this about 2 months ago, and I go back to that Financial Times
Interview.
that he did a couple times in the last few weeks, in the sense that market participants are not discounting what runaway inflation could potentially have these ramifications for. So, like, what are the
Bonds smell it.
impacts, right? What are the impacts that would have, and is everyone prepared for those impacts? And like, are they, accounting for and discounting for those impacts? And I gotta say no. I think that people believe that the default response mechanism is that, oh, they'll just print more,
Mm-hmm.
right? And that's fiscal. That's a fiscal statement. They'll print more, give more, because they just did that in such excess. It's hard to really wrap your head around. I mean, if a business wasn't out of business and never stopped and took PPP, and the business turned in the PPP payroll reports to verify that the PPP was given to the people, then what happened to the money that came in? They got to keep it.
And in some cases,
Okay.
they are talking about if you didn't use it, we're going to audit and get it back. How are they going to get it back?
Yeah, how are they going to get it back, and how are they going to audit? Because they can't even get to the audits they're doing now. And to do that, and so you think about the work that was done in a short period of time right there, like that's going to take a decade to sort through. So that impact is already in the system. So that's fiscal. Then you're talking about monetary, which is a totally different lever, right? And so when you really look at this situation, to me, I think that it's much of an unknown. It's much more Dunning-Kruger, that end of the spectrum, than it is kind of a blueprint of what we've seen. And it's more hyperinflation, as Burry said. And Burry got canceled. He said hyperinflation, and they canceled it.
You're talking about Michael Burry of the Big
Yeah,
Short
they
fame. Yeah.
canceled his Twitter account. He mentioned hyperinflation because he's got a large audience,
Yeah.
right? He's a quarter of, and I think his audience reached 3 or 4 million people, and they just removed him. And I think it's unknowns because you don't really know the knock-on effects of that, and you don't know the response from the constituents as their assets potentially get lit, and the expense of things doesn't change. So let's say that commodities and all the goods, you saw the gas and all this stuff's getting out of hand where they don't have it at the pumps, all of a sudden, things like that. And what is the response? They're just going to give people money like they did fiscally again? That's a misconception, because if they do that, that's further inflationary.
It
That
also
means
doesn't get their gas in the tank should it come to that.
correct. And then what are you gonna do with the Fed? The Fed's an interest rate manipulation mechanism. It's not. It's for mortgage-backed securities. It's for the reserve ratios of the banks. It's a mechanism for confidence and infrastructure support. It's not a mechanism that, as Powell has said 150 times in every one of his Fed uh, commentary after they do the announcement. He's like, we're not a fiscal entity. And that's what that's what he means when he says it. Like, they don't give money to people. The Treasury gives money to people. And so they don't have the ability to do anything except suppress interest rates and try to get lending cooking, and then deal with the bank's reserve ratio so that the banks are collateralized.
Well,
So,
banks on the overnight repo would disagree, but
yeah,
because
well,
they rely a whole bunch on that. But I
you
wanna-
get what I'm saying. Like, you get the big picture, in the sense that I believe that this is a lot more unknown, a lot more harder to throw a dart at, per se, because you don't know exactly the reaction. Like, mechanism here. Like I think that when I watch gold and silver the last week and a half and the
Well, before we
accumulator.
go to gold and silver, hold on. Let me go back to Michael Burry because the
Okay.
tweet storm that he actually made and was taken down is one prompt, if you will, for this conversation of 1970s style inflation. And of course, there are many, many who say not a possibility. We have stagflation potentially. I keep
Fair enough.
presenting, the inflationary definition of too much money chasing too few goods. But let me just go over real quick kind of what Michael, to set the stage. His tweet that was taken down, history is not useless. This text explores the 1970s American inflation, which is more relevant today than one might think. And when you were referencing all the stimulus that is US based, right?
Mm-hmm.
3 went to 6, went to 9, we're 11, we're up there, right?
Yeah.
That's nothing compared to global stimulus.
Oh,
So
I didn't even
central
count
banks,
that.
I know.
Yep, I didn't
So
even
then
count that.
he draws parallels between the market mania in Germany before inflation took off and the Reddit fueled buying of meme stocks this year that led Robinhood to temporarily halt purchases, right? And he was, of course, not behind, but involved in the GameStop bull run.
Right.
But he says before the German hyperinflation in the 20s, everyone from the elevator operator up was playing the market, and volumes became such that the financial industry could not keep up with the paperwork, and the bourse was obliged to close. And he says, sound familiar? Robinhood down. So when he started talking about the massive bubble, and he also said Tesla and Bitcoin, he's been, short since December. And they trade very much, they're strongly correlated, like 0.96. I forget what they are, but it's not near 1.1, but it's pretty darn close. So that was what prompted, some to kind of look again at that hyperinflation theme. And there was a chart that I actually grabbed and put up also for clients because I thought it was really instructive, and I kind of want to share it here, which was hotly debated, but this is a little bit of support for his claim. Now, no, he didn't put this chart up there. I went and saw this elsewhere. But let me just share this screen just to give reference. And we're not talking CPI necessarily, but let me explain. So this is a commodities, right, run that we're having right now, which is hot fire flames, and everybody, knows it.
Mm-hmm.
So right here, commodities nearing strongest reaction on record to global growth. You can hopefully see that. So back in the 70s, we had inflation. It stayed between 5 and 6% at the start of the 70s and dipped below about 3% in 72. But it went right up to double digits by 1974. And then you talked about, the Fed reaction to try and tamp that down. And then you just started talking about gold, which is very different because back then, Nixon under his policy was basically untying the dollar from gold, so that became a shock, and Bretton Woods was broken up. That really fueled the inflation of the 70s. Oil was like under $2, right? So it had a lot of runway. We have a very different backdrop now. We just, as you said, tons and tons of printing. We also were just, fixed rate of exchange, then went free, and we had a lot more, if you will, of kind of world currencies competing. And now, today, Druckenmiller actually was on CNBC saying he would not be surprised if the U.S. loses its world reserve currency status in the next 15 years. Lots to digest on that.
I think that the speed with which we move is one of the things that I was referring to with hyperinflation last week. If you look at like real estate, for example, and a lot of folks were, implying that it was a more of a supply and demand function than it was a monetary function. I would agree with that to an extent. But now, because of the commodities price increases, the building has slowed, scorched, like almost to a screeching halt. And to remodel or to build is so, costly and unknown that they're not, builders are taking less risk to try and construct. Therefore, supply decreases further. So it's like a chicken and the egg thing, which is first. Is it the fact that, there is genuinely more demand than there was before? Maybe a little bit last year because of COVID. But now we're in a situation where there's just simply no supply. And now prices are continually chasing higher and higher and higher. And I could, speaking just from what I understand, Florida, Texas, California, predominantly where I work with and talk to people on a regular basis, we're talking about like bidding, price bidding on property, not price purchasing,
Mm-hmm.
where real estate agents would be like, bring another 100 to 200 in cash for a $800,000 house that is priced at 800, that was 400, that now is purchased for $1,200,000 over the bid with cash as an incentive to sell. That's happening so fast that literally people are throwing a sign in the yard to sell anything that's not glued down. It's not a natural growth pattern. This is out of control. It's so out of control that have you seen you guys that you had, Michael Leibowitz, his
Yes.
partner, Lance
Mm-hmm.
Roberts, showed the image next to his office where all of the used cars were simply gone. And I can attest to that being a fact too, where I know people who've been offered more for their car that they bought 3 years ago than they paid for it.
They're
So
front running.
right.
And,
There's no image. So you have all the shortages from the supply and everything else. So
and the
I
market does
think
the
it's a
same. Not only do the consumers front run the panic about inflation, which by the way is Google is like at all-time highs the word inflation, but also the market. We've got CPI tomorrow and PPI on Tuesday, and these have already like since Friday and the disappointment of the jobs report, which was a historic disappointment. No one expected it to this point, and it did. They're front running with this sell-off in tech, this inflation burst still.
to me, it's the policy response. When I listened to the Financial Times, I think it was no, it was it was not the interview with Griffin. It was the one that he did, and I suggest everyone find it. He's not done a lot of like live interviews. It was like it was the interview with Clifford Asness, and they did it. It was in the last 3 to 5 months,
I was going to say it was
and
beginning of the year.
it was
Yep.
so they were talking about the policy response structure and how it just simply overcooked it. And so now you're dealing with a lot of these things that you a lot of the liquidity in the system is going to cause things that you can't really wrap your head around, and also limits the policy response that the historical policy response would just naturally throw forward. And so they normally measure CPI the way we would all measure CPI. They discount a whole bunch of different things in there, but the things that they actually are measuring are out of control too. And so when you look at what they do measure, and they're going to get big readings on this stuff, then what's the response? How are they going to quell the inflation in the commodities? All right, how are they going to deal with this? Like Bitcoin is
Yeah,
trading
because
separate of like gold and silver as a monetary kind of construction as it relates to tier one banking, and we've talked about that many times. Bitcoin is a commodity that's not tied to the banking system, and that's the total play of it. Gold, silver are tied to the banking system, tier one collateral gold in the banking system, and so the banks have a situation where they're looking at this going, okay, how's this going to shake out? What is the Fed's response to curbing inflation? They say they have tools. They were talking about it in that interview. What tools do they have with rampant inflation when you can't raise rates?
or speculation because when you can't raise rates because not only are consumers worried about it and obviously bidding up used cars and houses because of inventory so low, etc., and money sloshing about, but also institutions are buying up these commodities as hedges because they're concerned that we have a regime change, a macro regime change, which is not just a cyclical inflationary burst because of all this money that's been printed, but it's a secular change. And there's a huge debate about that, right? But bonds are really pretty clear. They smell it.
Yeah.
And now we have tech finally. I mean, yes, there are the poster children that like ARC that are down 40% from the high in December, but this rotation, if you will, into reflation that started last year now has big banks and analysts and talking heads all saying, yep, it's cyclical, it's confirmed, we're going higher, which of course is when it gets tested. But it doesn't mean it's any less, it doesn't have any less merit for a continuation of higher inflation. Yeah.
The Dow was rejected completely at 35,000.
So
So far, which
today was
super
a big
interesting.
deal.
It was
I
a big
know
deal.
you saw the
Market
selling
structure.
last week. You saw the structure already starting underneath the surface. And in all honesty, today I looked at this and I went, you know what? That not only the gap down, because we talked about the SPX trigger of 4170, and then it bounced at 4133, and then it gave sway. But the bigger issue is I went back when I opened up my trading room and I said, you know what? This is the biggest gap down that we've had in the SPY since June of 2020.
Correct.
And it was supported beautifully by certain, moving averages. And it was still early in the reflation theme, right? And they were still throwing, the kitchen sink, all kinds of money was still coming in and supportive. But the interesting thing was, we're not even close to that mean right now. So we've got another, few hundred points to fall before we actually get some solid support. So I'm kind of curious. This was the biggest gap down that we've had since June of last year. Not a lot talking about that, but it was.
No, yeah, I think it's total
And bonds were red.
total complacency across the board, right? But when you look at, I mentioned yesterday, I put out a couple tweets where I said IWM was at a very, Russell was at a very kind of precarious spot where it needed to go up and through the market node of volume and start, going towards newer highs and then higher highs. Or if it failed here, it was it could be very substantial because it's been here for 4 months. And most of the action inside most of these large kind of Momo names that are inside IWM have been very, very fall off in the last 2 weeks. Since we talked about it 2 weeks ago, they have they were all looking rough.
But energy is still bid. And I don't just mean the price action of the past few days kind of, sideways. I'm talking about the transition again of those who are buying energy, oil and gas plays, not only on the news of this, the biggest oil pipeline having its cyber attack, which is very worrisome, but also just the fact that it's a hedge on inflation, and they're still coming in to accumulate. I'm not talking about open interest in oil physical crude, which, by the way, I still contend if it gets above 68, we're going much higher.
Oh, significant.
But I'm talking about oil and gas assets as
Exxon was the 1, 2, 3, 4, 5, 6, 7, 8 of the top 15, unusual call activity.
Aggregate buying or selling in your options matrix.
Yeah,
I still see this solid. Yeah. Can you turn up your volume a little bit?
Oh, sure. Let me see.
It's probably going to now shriek higher to try that.
Better?
Nope. Try it again.
Better?
Nope.
Worse?
Keep going.
How about now?
No change.
Okay.
All right, I'll just that's a little bit.
How about now?
Oh my God, that.
All right. There you
Now
go.
I'm gonna bring this down because otherwise you're gonna deafen me.
Magic. Okay.
Oh, magic. Okay, good. Okay, so let's talk about oil because the shock back in 79 was a totally different animal, right? We had, oh gosh, decrease in Iranian oil output. We had the Iranian Revolution. We had Carter. We had we had embargoes. We had Arab. Oh gosh, very, very different. And yet, I can't help but look at the risk right now that we have of this oil pipeline. Is it just a tradable short like a lot of these drone attacks have been in the past 2 years, or do we have a bunch of folks that are going to start to see disrupted supplies? They're already at gas stations going, they're all out, but it hasn't caught on. It certainly hasn't made it in the news yet. So if we have 1 week of that, though, I think it's going to be felt quite strongly. So
yeah, you're far more in tune with the oil space than I am to speak about it. Like I think that anything that's going to potentially produce inflationary return that's protective of inflation. Like at the same time, deflation can be going down like big time, right? It can be happening, because they're almost like two totally separate things to me, in the sense that all the growth play action and all of that excess liquidity is like a lot of it been burnt through the system, and it's not coming back in the system, and people are going and taking their money to other places, and they're not trading as much. They're going to Disney World and things like that. And so that kind of retail chase of all that Momo stuff has faded to an extent. Then you've got the inflationary protection mechanisms that people are bidding into place. Well, I don't believe that's housing, because housing is subject to that, and interest rate issue. You look at like oil, just to me is like a natural play. You call it like a hedge.
But
It could be a hedge.
but it's real. I mean, we have, and it doesn't seem like much. It's $3, the national average for gasoline, but that's a 6-year high.
Right. Oh, well,
That's
yeah,
a
and then
6-year
you
high, and we don't even, and that's not even with a pipeline down. So,
Yeah, I mean, in the geopolitical stuff, I think this excess. I think oil's not an issue getting a hold of it. I think it's more of the like the transmission functions, the ins and outs of the system globally, that it can be glutted on purpose, or released on purpose, so that's to manage it. I think as the big players get concerned, and these businesses, to add another layer to the oil thing, because you talked about this last week, a lot of those oil gas explorers, and a lot of the oil gas transporters, and a lot of the oil and gas, not so much as the large cap, let's say mid cap type plays, they were all in deep trouble last year with the debt, and they were saved, right? Via proxy, the purchasing of HYG and the restructuring of their bonds under the table. And so they were all bailed out. So they did not, when oil went negative, they were salvaged, and now they're coming back. And now the free cash flow, so FCF for these things is starting to look pretty good in a world, as Jim stated. I don't know if he said it on the call, or the one I was listening to was Cord, but when you get deflation and liquidity issues, the free cash flow companies become ones that you like, because they can actually fund themselves. Well, when you look at gold and silver miners, they're actually they're producing massive amounts of free cash flow right now, as are these oil and gas explorers, which is so paradoxical, because typically they're destroying of money, right? Trying to dig stuff out of the ground. So they're usually dumpsters for destruction of cash, and they're actually producing cash at the same time that they're inflationary protection. So they're almost like a value play, as you refer to it all the time, like growth to value. They're almost like a value trade at the same time that they're an inflation hedge. Very, very bizarre. And it's like, that's that mechanism within, with the ins and outs going on in the economic system, that you have. This is the setback, or the setup, I should say, for those particular stocks, which is wild to even think about. So I think that's an added factor on the commodity itself, is that these businesses were salvaged. They were just, weren't allowed to go down at all. So they just rode right through it. And now they're on the backside of that with the pickup of
and now we have to do the inverse.
Demand.
We have to do the inverse. For example, Virgin Galactic, ticker SPCE, tapped
Yeah,
out at like.
I trolled that today.
I know you did. It was awesome. It was an awesome tweet. So, and it is a symptom of the other side, right? Where this liquidity is just fueling speculation. And it was funny because on May 11th, they plunged 20% after earnings, and I retweeted. I love this. Evan Lauren says, "How does a company with no revenues miss earnings?"
It's a great, yeah.
And it went from $63 to $14. It's December. It's the opposite of the physical zombie oil and gas companies. Not all of them are. Exxon obviously is not going anywhere.
Right.
But the point is, it's literally, we have this counterbalance with the stuff that was considered
distortions. You've just massive distortions because of the transmission mechanism of the liquidity back in last year. So it went, where did it go? Where it flows is just like the chase and now they're done with the chase, and now we're going over here to this stuff, and that's just, it could be a separate chase. I could tell you, looking at the Exxon charts, looking at the oil and gas explorer charts, looking at master limited partnerships, looking at gold and silver stuff, these on a big drop back, like a big setback. Oh my gosh, like these things could get out of control in the next year or 2 years if this stuff kicks in with these price
The trouble with
charts.
gold, I'm going to be the bear on gold just because, yes, I understand it's a calamity hedge and it's also sometimes currency, sometimes inflation hedge, sometimes this, sometimes that. But if you know, if the stuff was to really hit the fan, governments could seize both Bitcoin and gold alike. So
I look at it more like this. I totally agree with you. Like, for what it's worth, I fully agree with you. I think governments, as long as governments have the guns, like, they're going to be able to set the rules. Which
but
they
as
do.
trading vehicles,
So I think I look at gold and like silver from a commodities perspective, that it's used in a lot of commodities, especially with like the EV movement as a whole, and that's going to keep going. You got trains, electronic train, that kind of stuff is happening there, all over the world, and so I think that's necessary from that standpoint. And gold is a tier 1 asset related to the banks, and so it is actually a collateral asset in the system as a whole. It's not talked about a lot, but it is.
well,
So,
some places are now allowing that, to be Ethereum as a collateral asset. It's hit or it's small.
It's small, but like gold is like really like, U.S. financial institutions with the FDIC, gold's an asset, right? So banks hold it. So not small banks, but large, players have set aside holdings. The United States has set aside holdings. So it's still a portion and part and parcel of the actual global economic system. The Bitcoin stuff and all that stuff's outside of that. It's like a counter system. So, it's almost like, both of those, you hedge each other. I look at it more from, it's still in the system right now, and the system's in shock. The system's in shock on the other side of the shock that it was last year. We were in a deflation shock. Now we're in an inflative shock.
Yeah.
And the assets are swinging back and the liquidity is swinging from one side to the other side. And like that, to me, is the thing that I'm looking at from just sheerly a transmission, right, or transmutation. So it was here and now it's over here. How does that impact the things that are over here now, where the liquidity is now? It's worried and it's sitting over here now, right? Liquidity was worried sitting over there. Now it's worried sitting over here. And you've got master limited partnerships that are paid 10%. I always thought those were super interesting for the last 10 years, but man, they were just dumpsters. And then like they're salvaged, right? And now they pay 10% and you've got inflation. It's a very fascinating proposition, as well as like major gold miners that are a part of the financial system as it exists today. Now, whether that survives, I don't know, right? I'm not saying that. I don't know what the new financial system would look like if it didn't, if we reset this whole thing or whatever. So don't beat me up about that. But like this, as it is right now, this is a part of it. And these are the people that dig it out of the ground and they're making money. Commodities and everything associated with their cost, they can rake up, and then everybody wants to get a hold of something. The elixir's there for that stuff to get real hot, which could be completely counterintuitive to everything historical, because it should do this and it should do that. But at the same time, we're talking about 11 trillion to 12 trillion, whatever it is in the US, that this has distorted all of the functions and moves things around very quickly. Because if you think about just the amount of units that would entail, and then the money multiplier effect of that, if it's just math you're thinking about, that's much larger numbers moving much quicker, right? Because if it's a huge bunch in anything in life that moves swiftly, it's going to have a physics impact to this stuff. And that's how I kind of see this stuff right now. It's like, this is a lot like a huge mass chasing a small amount of things. And that's why this stuff, I think this could get really out of control, especially as like you have the other countries get involved too that have massive populations. Like China has a massive population. They need X amount of tangible raw goods, hogs, corn, wheat, grain, all that stuff. India's same bucket. We've had farmers going to like zero for years, And this is just an elixir for where there's just simply not enough people to produce any of this stuff. And we've got major inflation, which you need more people to supply it to cut the inflation down, right? So that you get more supply into the system than the demand is there. So I'm like kind of roundabout way defending your long commodities no matter what play, like that you've been kind of going back and forth the last few weeks with. But like I'm very much like concerned that this is like a huge amount of liquidity chasing a subset of specific things, like almost like a pack of great white sharks, and they're just eating through the system, right? And this is not dumb money. This is smart money.
No, and the monthly, commodity charts are just at an inflection point, which is really interesting given kind of the conversation that we have, because this multi-decade low in commodities that we've talked about has risen up from the dead, and not just oil from literally 100 plus points off its negative print back in May of last year, but collectively. So we know, lumber, goodness sakes. Copper, FCX is up 700% since its March low. So as you just said, the deflation spike triggered a pendulum response of an inflation spike. And corn, for example, China has bought more corn this year than in the past 20 years. So there's hoarding going on too in countries. Some have started to do the central bank tightening, whether it be raise rates or taper. We haven't obviously done that, and all Fed heads that came out today, I think 7, said nope, not going to change, not going to change. So they had a script, but it's interesting because right now we're at some inflection points as it relates to this commodity move, which has been very supported. The rate of change that you're talking about in interest in yields, which I've shown that chart, the ROC, right, for the 10-year, the 5-year. Unprecedented type of thing. So the rate of change has been very strong. The inflation expectations, which are the 5-year and the 10-year, they have been extremely strong, and they keep grinding higher. The food prices, lumber, real estate, all of that's kind of conspiring, if you will, to support a continued cyclical reflation trade, but we're kind of looking at it as a secular inflation, which could get away from the Fed as not just a community. Now you're saying more than not just a commodity super cycle, but as Burry puts it, a German style inflation that
Yes.
will break the economy. And
Yes.
that's the concern. So where, besides anecdotally, where else have you seen this talk of hyperinflation worry? Because I honestly, I haven't. I mean, I can see that chart that I showed you, which I thought was really awesome. The beginning of it. I can definitely, and I've been tracking this very closely since last year. Every single dip in the growth value rotation trade, and I just see continued strength, even when it rotates, into the safety and the defense. Whether it's so strong, it's not going back into the momentum plays, right? So not yet. They might have wonderful bounces, but it's not going back in as it, like, in other words, all the money that has come into the ARC fund since November, 55% of it is underwater.
Oh, that thing's in big trouble.
So I'd like to see how they're going to get out of that. And the Wall Street Journal just said the ARC is flooding. So that's going to feed on the concern and of how do you get out of that? Do you buy puts now that it's down 40%? I mean, this is a nasty kind of
I said this morning
baptism.
in reference to ARC that, what do you do when what she's doing now, she's selling Apple.
Oh my gosh, 1/3 of her
Right.
holdings in Apple have been sold to support her very underwater, I shouldn't say her, but their very underwater growth.
They're literally
place.
taking, you got licked, right? As a trader, if you've ever traded seriously, you've failed, or a couple times, right? Where you got licked, and you either do two things when that happens. You cut it, right? And reevaluate, and then reset and keep moving and make progress. Or you do what she's doing and you sell your great stuff to double down on your losers.
And she did say it's a wonderful buying opportunity
And then because she has a platform, she's talking her book, right? So she's doubling down with leverage and size, right? To then talk her book back. It's, hey, look, either two things happen with what she's doing. It's going to work or it's not. And if it doesn't work, what happens is that means she goes quicker, and it'll go way quicker, because now she's totally on the wrong side of the trade in size with leverage, as opposed to having some counterbalance with like an Apple or just a balanced portfolio in general. Meaning, to me, like, they just are not their zealotry of their faith in their model, which to each their own, it's worked very well for them, is now on the opposite side of the peak in the valley. Like, they're on the opposite side of the mountain, and they're not readjusting. Like, there is significant problems with the names that they were chasing, and they got big because those names got chased because of the liquidity coming into those names. If you look at her concentrations, they're all the same ETF. Like 70+% of all 5 of those have the same holdings, with Tesla being the predominantly number 1 holding of all of them, which means that, is it really genomics if it's got Tesla, right? Is it really fintech if it's got Tesla? Like, these are some really, nobody asks these questions on the way up, because it's a Momo trade on a Momo trade on a Momo trade with leverage and derivatives. On the backside, everybody's going, wait a second, right? And to her defense, at the blackjack table, if the cards drop right and she's triple, quadruple down with, asking the house for more leverage, then she could be sitting back in her spot within weeks. If she's wrong, it's over 3 times as fast as it took her to get to right here, because it's now on leverage. So I think they're at that apex moment. I posted some charts about it last night, where the weeklies on that, they don't look good. Like, she's under the VWAP on the weekly. She's under the pivots on the weekly. The volume point of control sitting on top of all those. The liquidity is out the door in size on those funds. She's literally, I think she's on a string here. And if it breaks the wrong way, like those names, she needs a run in those Momo names, Fuel Cell, right?
Planeteer,
TTD, yeah, all of those names. Yeah, she owns all those in size, and they need a run. If they get a run, like, and look, anything can happen, right? Like, anything can happen. If they get a run with the leverage that she's been putting on, that you can see in the options market, because she's been putting on leverage.
I have a really, just, I don't know, fool me once, shame on you. Fool me twice, shame on me, right?
No, totally agree. Yeah.
PLTR, case in point. It's already down from, hold on, let me just give you an example, because I like this example really well. So PLTR is the love child or poster child of many momentum chasers.
Share that. Can we see that? Yeah.
What? Oh, okay.
The PLTR. Yeah, share that. Yeah. Put that up here.
Yeah. All right. So it's the love child, or poster child of many a chaser, right? So it hit a high of 45 even. Okay. And it hit a low this morning of 17. So that doesn't, in a very short period of time, by the way, we're just talking about this year. You can see that, right? Okay.
Yeah.
But what's so interesting about it is today it reported earnings, and they were blowout momentum kind of earnings. In other words, 49% revenue growth for its first quarter. Sounds really good, but its EBITDA is 60 times forward EBITDA. 60 times forward EBITDA. So this is where the valuations start to matter in this type of cycle, where you have this growth to value rotation into assets that can be sold, into stocks that do have dividends, into stocks that have actual earnings, maybe not this type of earnings growth, but low book value and otherwise deemed active management type of plays. So this to me is a case study of, okay, now do they really put their money where their mouth is? Are they really going to buy this now that it is so cheap, relatively speaking, from 45? It had a wonderful one-day reversal, but are they really going to come in and bring that back up to 45? right? That's my point.
Yeah, no, I don't think that you're gonna get a 45 move. You just get counter trend moves now, right? Like that
Well,
market
that's
structure.
assuming you're saying that's a top. There are going to be many who disagree with you. It's a great buying opportunity, Kathy Wood said. So my
Look,
point is, it's going to be proven now.
yeah, that's what I mean. Like, when you look at this from a market structure standpoint, just like, hey, this is an auction, right? The market's an auction and it's been distorted via liquidity, but still an auction, right? We'd say, oh, that's a huge move in a year. That's literally like what you used to see in crash moves in like 1987. They were like, oh, that's the 87 move. That's March to May in pound here, right? So, the distortions taken
Yep.
into account as some measure of ratio here. Like this is, let's just look at it as if it was not like this large in numbers. And you're just looking at the auction. That auction has to get back up above a certain threshold or that thing's headed lower, because the sell side already showed you what they thought of it at anything above 30 bucks, really, right? So that thing's going from 16 to 30. That's 100% move. She knows that, right? And so she's betting, right, that she can throw leverage onto that and tag and time that 16 to 30. But be my guess is the strategy that they're deploying right here, and to try and get, and that cuts her break even from what, 50 or 45 to 30, 35, right? If she throws on mass leverage, she can make a move back from 16 to 25. And I don't know if they, I've never really looked at the ARC stuff that much. I'm just looking at it from a like what leverage they take and the options, like trades they take and like so forth. I can see some of that stuff floating around, but to me, like it really is like a strategic. That's a total gambler's move. Like that's a gambler's move. That's not even a trader's move. Trader's move would be to short yourself more than likely, right? Like she would have shorted herself.
I asked that question. How do they hedge that?
I'm shorting myself
concentration?
on those holdings, and I would have collared and hedged those holdings there at the top if that was my job, right? Like I wouldn't have like sold my best stuff to buy my. It's like that's like not. I don't understand that in any way, shape, or form. I just don't understand the strategy at all. But that's what's happening right here. So if they get the bounce with the leverage up, it doesn't have to get back in a bullish trend. It just needs to get the counter trend, sharp bounce, the V bounce that they're looking for, so they can pick up that leveraged move. If they get that, she might be able to sustain. But I think that outflows to her are scarier than the actual maybe trading performance or not. If you look at the flows on my side of the stuff that I posted last night, they're just debacles. Like, I mean, like peak to now way other end of the spectrum. And even like if flows are net negative, so, and I'm talking security flows, like the actual underlying ETF flows of volume, the velocity of transactions, and the dollars coming in, that's coming out, and it's coming out fast. And so and it all times back to when Wang blew up, right? And since then, the flows have gone out the door on that deal. And so she doesn't have the incoming flows. So no matter if she does perform, ETF's got to have flows coming in.
But it's
right?
also Tesla that's so heavily weighted, and Bitcoin, or the Bitcoin Trust, GBTC, which is so heavily weighted, and they have been bleeding lower since December. So they haven't, they're not destroyed. They've obviously reset. Tesla does look like it could get destroyed, though. It's got to look.
They all have what dude calls the boot, what Jen calls the boot. Like it looks like a shoe, right? It comes straight down like the tongue and then rolled over like this, and it looks like a boot. And the boot gives you a good kick in the ass. So like a boot looks like it's about, I mean, they all look like boots, like on the backside of a parabola. And so the parabola breaks, market structure corrects real quickly, and it finds a first level floor, and then it bounces. And it's bounced, and then it rolls over because there's just nobody wants it anymore, and the parabola is broken, and now you're chasing back down to the bottom of the parabola, and that's
all right. So we have to talk about that, because this is interesting. Today I actually saw this and tweeted it. Speaking of your great quote when we did that.
Trap longs, yeah.
Yes. So lumber is down, right? And so I took this because I've been waiting for a particular price in lumber to hit tag and then pull down, which would be risk off. Long
Yep.
story short, it's 1575 in the futures, and that's been my line for a long time. So now today, Stinson, by the way, I know it looks like Paul Bunyan, but he's the lumber guy that I follow, and he says lumber is down, massive pool of offers trying to sell July but can't due to limit triggers. They're stuck.
Oof.
Meanwhile, no sawmills in Canada have offered any wood for sale yesterday or today, sold out. Hard to see May futures not hold its value while speculators panic in July. So you can see this, this thread. By the way, there are a few in lumber that really just they have strong reasons for following them, because I think lumber is a symptom, right, of this parabola equal trap longs, which equals liquidation risk. And so anyway, for me, 1575 is a short, but it front ran with yields early. So this has been in play for a while. And by the way, the mean before lumber, went into parabolic chasing with housing prices and Bitcoin and a whole bunch of other things, its mean was like $260. So it is far from its mean, and that's always a reversion trade. But it doesn't mean it's not going to create a new mean. In other words, now its new normal, quote unquote, will be probably in the 650 range. So it's probably not going to fall below 650 for a long time.
Yeah, I would agree with that, especially with what we're dealing with overall.
And we have the same kind of thing happening across. I think sugar is just starting. On a monthly chart, corn is already, soybeans, et cetera, et cetera. So we definitely have a lot of commodities that have been not only bid up, but they're still in physical hoarding mode by some countries, India, China. The bulk rate shipping rates have doubled, and there's a reason that we have inflation in input prices. But most think this is going to be just transitory, and I don't mean just the Fed. There are lots of analysts that say supply will become unburdened again. They'll build new chip manufacturing and machines, and we will have equilibrium again. But in the meantime, it's the forget Fed reaction function, the hedging activity and the consumer behavior is driving a lot of this inflationary pricing, and it's except for the parabolas, which obviously break and then they have to revert, no question. We are doing a lot of front running of CPI and inflation and deleveraging at the same time, where historically long momentum, right, is that bond proxy trade. Now bonds smell inflation. They have been selling off. They're a good solid 22% lower from the highs, and they don't look bid at all. So I think this is a continued growth to value rotation trade, but the value pockets change a little bit. In other words, we had a nice bid in XAR, which is aerospace, with like the Northrop Grumman and that kind of stuff, and Staples and oil and gas. They're staying bid. Transportation, for example, they're staying bid, and tech is still taking it on the chin. So we might have some counter trend bounces in tech, which are very fun, technically speaking, to trade, but it doesn't feel the same as this massive run up from, prior years. It feels very much like a regime change.
Very much so. And you got negative gamma now on everything. On most of this that you're looking at, everything's negative gamma, versus it was so positive rich gamma for the last 12 months, which has changed as of the beginning of May. What I was going to say is that I think my last thought on the inflation piece is like most things that go really bad in life, it's slowly, and then it's all at once. And you go to a restaurant right now, and we've noticed this, and Laura and I have noticed this last 4 weeks, and the meals are significantly smaller. and there's not a lot of people there working, but that's a separate issue than the commodity itself being about half the size. And let's call it like from anywhere from a moderately expensive place to an expensive place, and even to like your fast food chains, there has to be a cut somewhere. And so it chips away, it chips away, it chips away until everyone knows what everyone knows, which is, oh my God, we have a real problem, right? And that's when you got everybody in the world chasing the same raw goods at the same time with an unlimited supply of liquidity that's been created, which has not been the case at any time that we've previously entered into one of these equilibrium imbalances, which is what really concerns me about the whole thing, is that the X factor that is being totally discounted, which I just can't wrap my head around why economists and so forth are discounting on the equilibrium conversation, the quantity of fiscal dollars put directly into the ecosystem. It's not like anything's ever been seen before. And that directly went into supply and the acquisition of goods, raw goods. And it was an overreaction of epic proportion, which isn't going to just equilibrium out. I would argue that it creates all new equilibrium levels, all new structures that if it's not sorted through, it can just restructure everything, because it's not going to just self-resolve, because you destroyed equilibrium with the quantity that you threw into the system that wasn't from the system. So if a system is functioning with 15 trillion, for example, and you throw in 5 more, it could be argued that in a short period of time, that will find some sort of natural equilibrium where it will find 5 more trillion in value, right, to create, so to speak. Well, what if you throw 35 on it? And it went from 15 to, 50. How does the same equilibrium structure work for that? How do the same rules work for that? Well, that excess is going to go somewhere, right, and cause things to occur. And that excess is just not accounted for, as if we lost that much GDP, which I would argue it just didn't happen. It happened in some countries. It did not happen in the United States, because the companies that were responsible for that output were salvaged, and then people were remunerated. So the GDP really didn't, and you've stated this the last couple weeks about that, a lot of the growth has been in direct payments of the savings rate, right? That's just coming directly from the government into the bank, right? So the people and then to the bank. That distortion of that 35 trillion as an example, and that's a made up number, right? Is that really gives you an idea of what I'm referring to. It was 15, you add 5, which is what we've done in previous crises. We'd go down 3, add 6, overdo it, then it would chase back up to itself, create a new asset kind of inflation. We threw about 6 times as much as we actually needed at it, and now that's roaming free. And it's like, and I don't have all the answers, but I could tell you I'm not so convinced that there will be equilibrium. I think there'll be new normals, and whatever those are going to be wonky for a little while, trying to sort through. And it's like your lumber number. Lumber's 200, now lumber's 7, right? And that then all you knew your levels go from 7 and on. Like, well, then how does the construction complex, who's riding high right now, readjust as demand diminishes, costs go higher, right? And everything starts getting, and the demand really starts to diminish as deflation sets in other areas where, I think the impulse is that the government just fixes everything. Well, they did that here with the fiscal, but you can't throw more fiscal here. You can. They can, but they can't, because it's way too much already. And you
Well, what's way too much? It's already 20% of GDP.
It's
at least.
So
I think it's more actually.
This goes to the far side. Then you go, what can the Fed do without sacrificing the pensions? With the interest rates, they're gone. The minute that they raise rates and really tell, like, they can't do a Volcker move. which it would take to stoke this. Immediately, it would stoke it, but they can't. So what is the response now? Which is the last, and that's the last thing I'll bring back to.
By the way, they also tried price controls during the 70s. That backfired huge.
Doesn't work.
Yeah.
That doesn't work. It's not. It's an ecosystems are just economic ecosystems function just like an ecosystem, like a rainforest. There's inputs, there's outputs, and the levers that they function with for messing with interest rates are to try and mechanize that to a degree. But when they threw the fiscal in there with the mechanized interest rates inputs, it got all wonky. And so the ecosystem is jacked up, just like it is when you put too much sun and not enough rain. Like you end up with a desert. Too much rain and not enough sun, you end up with a different kind of thing. And so, that's what I think we're dealing with, which is what Griffin was saying. It's like it's unknown unknowns as to relates to the overstimulate response that was just significantly more than was ever necessary. And it's not just kill the dollar. I think we're talking more like something else, like that is an ecosystem alterer. And I call it a life altering event, like back in COVID, like LAE. Like COVID wasn't a life altering event. The stimulus was. I missed that. The stimulus was a life altering event. It has simply reshaped the way that we're dealing with a lot of things that are going on. And I hope that there's equilibrium and we just bring all of our productivity up to that level of the stimulus that's been created. All we're seeing right now is prices are moving to higher levels, not productivity, not economic output, not even ingenuity. Like innovation's moving fast, but towards AI and automation. Like to give you an example, like this is a prime example from Crunchbase this week. Restaurants are having a hard time filling jobs. Liquidity is abundant in the venture world. Automation inside the restaurant complex to replace jobs has seen more investment in the last 45 days than in the last 5 years. The response is not what you think. With excess liquidity, people don't want to work. Okay, then the jobs won't come back. They're going to be automated right out because innovation comes in. There's a lot of like moving dynamics to this that it's hyperinflation that then like, the conglomerates will always have the moves to play the cards with this because they've got the excess liquidity and they were salvaged through the period. It's the other side of it that I just don't know how this price stuff shakes out. Like, you can't sustain like the previous building infrastructure, right? You can't sustain that with a $700 lumber price without raising prices at a permanent high plateau of, let's say, median house price was $350. Now the house prices are $850. Okay, so how does that work, right? When wages don't go up, well, we're going to make wages go up. Well, okay, then you're going to get more of that automation, right? Because the businesses are just simply not, I'm not going to do that. So I just won't hire. I'll just replace. And that means better productivity for the output, better returns. Then what happens to all those people? Do we just keep doing fiscal in the form of universal basic income? And I think that's really what we're standing. I'm going on a tangent again, like I did last.
No, I'm grabbing something because I think it's worth note. Just two things that that come to mind. First of all, this Charlie McElligott, which was Nomura, brilliant. And since last summer, I've been on this track that we have a macro regime shift from duration to reflation. Okay, so just Tuesday, he wrote, now it may be approaching escape velocity.
Oh, man, totally agree. Yeah.
Yeah, and this is brand spanking new, right? So I just saw this. We get our PPI numbers on Thursday, and they're lagging anyway, right? CPI is for last month, so it's still going to run hot for May. We'll get it in June, etc. But one of the points was, China, where PPI jumped to the highest since October 2017 on base effects and higher commodity prices. This is what we're looking at potentially here as well. So escape velocity is one way of writing it. Another is when I did my, piece we talked about in March, right? When I said there's a pivot potentially to oil. And obviously we've been digesting for several months after a $100 run in crude off the negative print. But I said at some point this momentum driven bond bubble will be unwound. This is before we had the drawdown in bonds, but I'm just saying this was something I had written. Granted, it's fully like a fully locomotive, needs miles of track, but it's going to plan perfectly when, in other words, I got to back up. It's in fact higher equities that triggers a selling of bonds that causes the next market correction. It's going to plan perfectly when bonds roll over, structurally forcing rates to pop. We've already had that. Then oil spikes with the reflation trade. Think inflation spike, and we're in that right now. While momentum stocks are sold off because they're overvalued relative to value and cause indices to correct. So I think this is a liquidity, that is challenged in a bond sell-off, and then volatility in the bond market spills over into equities. So that's a little bit of what I'm, always tracking is when that rotation emerges. And right now we had a solid, bond sell-off with stocks. That's the risk parity that is offsides, and that's dangerous to risk equities. And now with this parabola in lumber, for example, correcting hard potentially, that's also risk off relative to gold. And you are saying the same thing. You're seeing in your flow materialize energy, right? And gold and silver again, right, coming back in. So this still is reflation. It's safer. Safety pays right now, or defense pays.
Yeah, totally agree. And like you look at volatility this morning, it spiked, right? Like right out the gate, and the ETN spiked, and, gold and silver got hit a little bit, but then they were bid strong, close. So was oil, a lot of the commodity stuff. I think this is just to trade each channel independently, because liquidity, this much excess liquidity is gonna, like you said, pays to be safe, and being safe is gonna be pretty savvy, right? It's not gonna be historical. It's gonna be being pretty savvy. Like you're gonna have to be pretty agile and pretty savvy. I think going forward for sure.
Well, let's watch what happens with the oil pipeline for sure, and continued price pressures, if you will, not just in commodities, but also in bond land, because we really, there's not an expectation that they're going to fall apart. But, right, if they smell inflation and yields get a solid trigger higher, that's going to bring more volatility into equities, even though it's typically inverse, right? It won't be that time. Yep. So, and I don't know what else to say. It's just, for me, it's early innings to say hyperinflationary, but I see the point. I'm not sure when that would be confirmed. Cyclical to secular, inflationary to hyperinflationary, but I see the point. And that particular chart for the 1971, I thought was really the best example of where we potentially could be. And speaking of where we could be, I'll bring this up to Katie Stockton on Thursday. She's going to be in, and she is technical analyst to many an institution. So I want to find out what her big picture inflation read is. We got Jem Carson last week saying definitely sees inflation continuing. So there are a lot in this camp. Lots of notes keep coming out, like the Nomura one that I just saw before we came on, saying this could go into escape velocity mode. So I think there's lots here to keep talking about.
On your chart there is, are you at that first marker, or is that fractal further down to the right at the second almost breakout marker, right? We don't know, but like I think realistically escape velocity is very, very real. And then the flip kind of on it, where it does the thing, is counterintuitive, where it incinerates equities, exercises volatility, and then you get the commodities running hot,
which is a headwind to the economy, and all that growth that is being fueled right now by stimulus. If they don't have any money, anywhere, any gas to put in their car, it doesn't matter.
And this is a great way to close it out. And then you have all that liquidity that was thrown into the system, looking at that formula unfold, where the commodities get turbocharged and the equities are getting crushed and volatility is spiking. There will be a reaction to where liquidity flows in that moment. which is what creates terminal velocity in every
And
way.
we keep getting confirmation of that. The Glencore CEO said we need copper prices to rise 50% to even meet demand or something. I mean, it was like there is no lack of confirmation in corporate, executive suites that prices are going higher.
Yeah.
So we'll keep talking about it, but
We'll
thank you
find
so
out
much
soon
for
enough.
yeah, thank you so much for joining. And again, this will be on my YouTube channel, LaDuc Trading. It will also be on a podcast uploaded, so check it out. Apple will have it, Spotify, Audible, the usual suspects. Very grateful for your time, Jonathan, and everyone who attended. So we'll do it again next Tuesday. But first, we've got, like I said, Thursday. Katie Stockton comes in, and we'll get her read as well. So again, thanks so much for attending.
Thanks, everybody. Thanks, Samantha.
Take care. Bye.
Bye.